All right. Thank you, everyone. I think it's a pleasure to have your company today here. The topic that I'm covering is navigating financial risks, trends, and strategies for resilience and growth. I think a lot of my job was already done by the panel discussion we had before this. I think the esteemed panelists covered almost every area that I wanted to touch upon. So I think I would treat this session as a kind of a summary. I've also tried to put some kind of a structure around what can be done in financial risk, how it has been utilized or should be utilized in government agencies. So at any point of time, I think at the end I would leave out a couple of minutes for questions. So I hope you find this insightful. And all right, so I'll start with a broad description on risks. Mostly, this helps put things in perspective. The world we are living in, we can see that the world dynamics have been changing quite strangely in the recent few years. So I think in terms of geopolitical tensions, there's of course a couple of wars that we are facing that create uncertainty in terms of commodity supplies for us. There is geopolitical tensions in terms of trade wars that we are facing with different geographies, which affects the markets that we are sitting in. For example, if a country decides not to export certain commodities for us, our automobile sector might suffer, and hence our financial institutions might suffer. So we have to take a holistic view of things. A couple of areas that I have pointed out here includes, the geopolitical tensions, trade wars, of course, that we are facing. There is rise of new risks also. India is very much exposed to climate risk as well. And we are seeing the impact of climate risk in a lot of financial institutions, especially if you look at the data for microfinancial institutions as well, that is available through different forums like the reports released by RBI or other kind of reports that are available. You would see the impact of new and emerging risks that we are facing. So how are we prepared? How are we dealing with these risks, which are fairly complicated in nature? For regulated entities, regulation itself compliance can itself be a risk. So I've pointed that out as one of the factors. And there is, of course, the tech and infrastructure related risk, which I'm pointing out below. Because a lot of us are sitting on legacy systems today. We want to utilize a lot of emerging technology in terms of software. We want to use artificial intelligence. We want to use machine learning technologies to build advanced systems. But is our legacy installations that exist in our organization ready for this, prepared for this? Are we nimble enough to change it? So that itself becomes kind of a risky proposition for us. So taking this entire picture into context, I'm primarily talking about financial risk today. So what kind of question and decisioning happens for a typical financial risk manager in whatever capacity they are sitting? I come from a banking background. I've worked with advisory companies, consultancies, and these are typically the kind of questions which come up in any discussion when you're holding with maybe the C-suite people or even people in siloed risk departments. So what is the risk in current scenario? Where do we see the future scenario evolving? What kind of stress testing analysis can we do? How can I stop fraud earlier in government agencies? This is the most pressing question. And there are other questions around, am I maximizing risk-adjusted performance? I think the CEO ma'am from NPS also touched upon this in the panel discussion as to how we can deal with a risk-adjusted performance wherein we can simulate certain outcomes and see how well our regulated entities are performing. So these are all the areas or all the Q&As which happen typically in a financial risk management. So to put into perspective from a government institution or a government entity perspective, we have observed, or at least in my experience I have seen, I can divide it into 4 different areas. So there are government departments like your Ministry of Finance, Ministry of Labor, which are of course responsible for maintaining stability in the system. But there are other entities who deal with risk in different ways. So you have your supervisory bodies, you have your statutory bodies or quasi-government bodies, and then you have your regulated entities, which are, of course, the ones who have to face regulatory risk as part of these changing policy environment. So in each areas, there are different entities that we work with. As part of SAS, we have held multiple projects with these entities. A lot of these entities are handling risk on a more proactive basis. For example, I would take the example of RBI, which is probably the more active or supervisory agency which is dealing with building machine learning models to handle fraud more proactively for the entire industry. So they are collecting data from different regulated entities, trying to build a machine learning model which gives you these signals as to whether uh, there is any kind of pattern or significant pattern that is there in the industry, and pass on those signals to the regulated entities. So they themselves are housing intelligent risk management systems. Then there is agencies, other agencies like SEBI, which handles a recent case which we are seeing in the news on the on a particular fund management company which has been dealing in some manipulative activities. So how do they find out all of these things? Is because they are housing some of more complicated system within the organization. So what are the different types of risks that they are tracking? I've just listed some of these. These were part of discussions also. You would have seen credit risk is there, operational risk, fraud and misconduct, there's asset liability management, there's AML. So all of these areas are being dealt by all of these different organizations as to how they can manage it. So I have just structured these different risk areas under two different silos. So I'll call risk management as financial risk management, which deals with the typical risk which is faced by institutions which are managing core financial risk, which is your credit risk, your asset and liability management risk, your liquidity risk, fund performance, climate risk, and governance. We have dealt with all of these areas, and all of them form part of something called as an integrated risk management. You cannot look at them in a separate way. More and more, the entities are moving towards having an integrated solution for all of these different risks, which sit under risk management. And then there is, of course, fraud and compliance, which is kind of the use case which is more studied and more well handled, I would say, in the government institutional area. How is AI helping drive risk management tomorrow? So AI acts as kind of an enabler. The systems, the policies that the institutions have are still very much in place, but AI acts as an enabler for us. It allows me to probably have a better data quality. It allows me to have more sophisticated model. Models have always been there. For example, if I take an example from the banking industry, we have always been using machine learning models. But what has changed recently is they have become more democratized. You have better access to it. All of these open source platforms are also providing you more capability to build different kinds of models. So the models have always been there, but the accessibility has improved a lot. The compute power has improved a lot. And that is where it has become more of an enabler for most organizations now who do not have the kind of business intelligence units might be that is required to build these kind of models. So AI is acting as an enabler for digitization of all of these risks. And the outcomes, of course, that they are looking for is improved performance, in certain cases, improved revenue, reach more customers who are out there in the market, which we wouldn't touch in case we did not have information for them. So more data, better models, and of course, better outcomes. All right. So what are the factors which are influencing risk modeling? So there are different layers to artificial intelligence, or AI as we call it. There's machine learning models, there's deep learning models, there's of course Gen AI models, Chat GPT and Grok, which one of our keynote speakers spoke about earlier. And there's of course natural language processing. All of these different models are being utilized in different capacities. For example, natural language processing is used by regulators to study the submissions from regulated entities. So this is broadly used to understand if there is a study that can be made from these submissions, which are mostly digital image mannered documents which are submitted, and if there can be some kind of an operational risk which can be identified from these areas. So we have had discussions with regulators who wanted to understand operational risk through these historical data also, which are sitting in the form of images with them. So that is where AI is helping. In terms of machine learning, I've already given out a couple of examples where SEBI and RBI have been trying to build these models to understand the risks which is sitting in the industry currently. So I'll talk about case studies where SaaS has been involved and share some of our experiences in terms of how we have utilized these advanced methodologies, artificial intelligence, machine learning, NLPs in different areas, and how we have been able to derive benefit out of it. And I think I'll touch upon the first area. There are three areas broadly I want to talk about, which is responsible AI, and second is how supervisory technology can be enhanced, and third is around end-to-end credit automation. These are broadly the three case studies which I want to bring to light today. So, what is responsible AI? There was a lot of discussion on responsible AI that was done by a couple of keynote speakers, even in the panel discussion. There is a certain kind of hesitancy in adoption of artificial intelligence because there are inherent risks involved in artificial intelligence. One of the risks is, of course, that it might give you biased results. After all, it's trained on historical data. The other risk is, of course, that it might not behave the way you want it to behave. So there are hallucination problems that exist and there are multiple case studies like this which have come across on how AI may go outside or color outside the boundaries which it's designed to use on. So responsible AI is one of the major areas that we have been working on. In this regard, there has been multiple news, like I mentioned about Prime Minister Modi has also in recent the BRICS summit spoken about how responsible AI is the need of the hour. One of the case studies which you see here is on Amazon using its artificial intelligence models in a way where they ended up having a gender bias in their model. Now, these are restricted variables which you generally wouldn't use in a controlled environment. But if you use your AI without proper boundaries, without proper guardrails, you might end up with a more biased outcome from your models. So what is SAS's experience in this area? We recently collaborated with a central bank from a major economy in the Asia Pacific region, wherein we developed principles for building responsible AI. And these principles were called FEAT. FEAT essentially stands for fairness, ethics and accountability, and transparency. So this is a toolkit which is devised and incorporated by vendors into their systems so that they can have proper guardrails for artificial intelligence and how to govern artificial intelligence. This has been adopted by multiple agencies and banks, especially in the Asia Pacific region, wherein it has helped them remove bias from their system and also remove regulatory risks for yourselves. Because if your models are not working the way you want them to work, you might be facing regulatory risk. Some regulator might come and question your models themselves. So these are principles which are adopted in a way so that we can also meet the requirement of the regulator, and we can use artificial intelligence to the extent it was designed to be used and not be worried about outcomes which might be related to certain of these areas which can be handled by all of these tests which are embedded inside the tool. This was done with Monetary Authority of Singapore, and I think this is something which has been adopted now and is considered as an industry standard. And a lot of other regulators, for example, in Canada, in Europe, have also started working along these lines, this line of thought on how to provide a general framework to the industry so that they are not worried about regulatory risk. So this experience is of course imbibed by SAS. We bring it out through our tools and systems. The other experience which I want to share is of course around supervisory technology. Throughout the globe, SAS has been supporting supervisor in conducting something called as risk-based supervision. Now, risk-based supervision is something which is also done quite widely in India by, if you know, Reserve Bank of India, and also to some extent now the insurance regulator also accepts multiple parameters from the regulated entities and tries to analyze this data and see what kind of stress sits in the system. For example, if you look at the Ministry of Finance FRBM reports, they always talk about macroeconomic stress scenarios on how the fiscal deficit might be impacted by these different scenarios. So how are they able to do this is through using these technological frameworks wherein they can ingest a large amount of data and then try to arrive at certain signals from this data. SAS enables, and we have done this in India and outside of India, wherein we have managed to build a framework wherein you take a lot of transactional data, you bring a lot of market and econometric data, and you take all of these regulatory submissions, and then you deploy models on top of this, a modeling layer, which is, of course, again governed by a principle which I spoke about in my last slide, and then come up with these scenarios and stress testing analysis that can help you come up with outcomes which sort of handle systemic risk much better. SAS has also, in similar capacity, worked with a very large stock exchange wherein we wanted to detect patterns as to whether there were any manipulative trading activities which were performed. This is again some of the learnings which we are coming up as we have been deploying an increasing usage of artificial intelligence and machine learning in India. So fraud detection is through these machine learning algorithms which tell you if there is some kind of manipulation which is actively happening through larger players in your economy. So this is again one of the interesting use cases which we had for trade surveillance activities within a stock exchange. We have, of course, been working with largely with pension fund supervisor also. So we have a German pension fund supervisor which has been using our system over a couple of decades now. So machine learning algorithms they were already using for a very long period of time. They have enhanced that usage. They are trying to see the kind of stress that is sitting in their system through some of these machine learning models. And that also kind of opens up the possibility for a broader engagement by other industry players because they are aware of what kind of supervisory activities our regulator is currently carrying out. And finally, I'll just take a couple of more minutes to explain this end-to-end credit automation. So in India, financial inclusion is, of course, one of the areas which is, paramount, and it's always at the top of priority for any government organization or any financial institution. What is limiting the use of or dissemination of credit or financial inclusion has been the amount of data you can collect for some of these people who are probably in remote areas, who are handled through microfinance institutions, and larger institutions might not want to engage them because of lack of data. Now, there is a study which has been carried out, and there is a significant amount of synthetic data that can be created for some of these areas based on a fewer or a smaller size of data, so that you can build more intelligent models and you can disseminate your credit to a larger population. So you're not limited that, I have only so much amount of data in this geography. I don't know what the larger population will do. So you can utilize some of these artificial intelligence techniques like synthetic data maker that allows you to create a larger data set from a smaller data set, and then you can probably bring more people into the fold. And this can be done through an end-to-end credit automation, of course, which brings in a lot of social factors also. You're not just using credit bureau data, but you can also utilize some of the industry data also, some of the social parameters also to disseminate credit. So I think this is where the real value comes out from artificial intelligence, if you can improve the quality of people by bringing more people into the fold of financial inclusion. We've done, again, we have a very strong case study in this area, wherein for one of the Asia Pacific large public sector banks, we saw that there was a 20% increase in the amount of credit dissemination. So, of course, there were challenges in terms of wider customer reach. We use SaaS risk modeling and intelligent decisioning kind of tools to automate their credit decisioning process and reduce the likelihood of defaults also. So with that, I think I'll just conclude my presentation. If there are any questions, I'm on booth number 2, and I'd love to have a discussion with you on this. Thank you.